Look, I need to show you something that most financial advisors will never tell you, and honestly, it's going to make you uncomfortable. But if you've got money sitting in a traditional 401k right now, you need to hear this. Your retirement account isn't what you think it is. You see those numbers on your statement every quarter? Those aren't real assets. They're promises, digital entries in a database. And the difference between a promise and actual wealth is about to become painfully clear to millions of Americans. Let me explain what I mean. When you look at your 401k, you see stocks, bonds, mutual funds. But here's the thing. You don't actually own any of that. You own shares of funds that own shares of companies. You're 3 layers removed from anything tangible. It's paper on top of paper on top of paper. And in a real crisis, that structure collapses like a house of cards. Think about what happened in 2008. People watched their retirement accounts get cut in half. Literally half their life savings gone in months. And here's what nobody talks about. Those were the people who got lucky. They still had something left. But there were others, people who had their money in Lehman Brothers stock, in Bear Stearns, in companies that just vanished overnight. Those folks, they got zero. Not half. Zero. Now I know what you're thinking. But my 401k is diversified. I've got index funds. I'm spread across the market. And sure, that's better than having everything in one stock. But you're still completely exposed to the same fundamental risk. Everything in that account is denominated in dollars. Everything depends on the financial system staying stable. Everything relies on counterparties fulfilling their obligations. Let me paint you a picture. It's 1971. You're a worker who's been diligently saving. You've got bonds paying 5% interest. You feel secure. Then Nixon closes the gold window. Suddenly your dollars aren't backed by anything. Over the next decade, inflation runs wild. Your bonds that were supposed to fund your retirement, they're worth half what they were in real purchasing power. You did everything right, and you still lost. That's the paper asset trap. It looks safe until it isn't. And right now, we're seeing the exact same setup, just on a much larger scale. The Federal Reserve has printed more money in the last few years than in the entire previous history of the country. Think about that. More dollars created recently than in all of American history combined. And where did that money go? Into financial assets. Stocks, bonds, real estate. Everything inflated together. Your 401k might show bigger numbers, but what can those numbers actually buy? Here's where it gets really interesting. While regular Americans have been piling into paper assets, central banks around the world have been doing something completely different. They've been buying gold, physical gold, not gold ETFs, not gold mining stocks, actual bars of metal that they're storing in vaults. The People's Bank of China has been accumulating gold for months straight, not slowing down, not taking a break, buying every single month. Russia's been doing the same thing. Poland, Hungary, Singapore, India, central banks everywhere are loading up on physical metal. And these aren't small purchases. We're talking hundreds of tons, billions of dollars worth. Now ask yourself, why would central banks, the institutions that print money, be trading their own currency for gold? They have unlimited money. They can create dollars, euros, yuan out of thin air. Yet they're choosing to exchange that for metal. What do they know that you don't? They understand something fundamental about the difference between paper and physical assets. Paper can be printed. Paper can be inflated. Paper depends on trust in institutions. But gold? Gold is finite. Gold can't be created by a government decree. Gold has been money for 5,000 years, through every empire, every currency collapse, every financial crisis. Let me tell you about the COMEX. That's the major exchange where gold futures trade. It's where the price of gold gets set. Here's the crazy part. There are about 100 ounces of paper gold claims for every single ounce of physical gold in the COMEX vaults. 100 to 1. It's fractional reserve banking applied to precious metals. What happens when people start asking for physical delivery? When they want to convert their paper claims into actual metal? The whole system seizes up. We've seen it before. In 2020, during the COVID panic, the gold futures market nearly broke. The spread between paper and physical gold blew out to unprecedented levels. People were paying $100 over spot just to get their hands on actual coins and bars. That was a warning shot, a preview of what happens when confidence cracks. And we're heading into an environment where confidence is going to be tested, like never before. Think about the debt situation. The U.S. government is now paying over $1 trillion a year just in interest on the national debt. Not paying down the debt, Just the interest. That's more than we spend on defense, more than we spend on Medicare. And it's accelerating. Every year, the debt grows, which means every year the interest payments grow, which means every year they need to print more money to cover it. This is a spiral, and there are only two ways out. Either they default, which would destroy the dollar's credibility overnight, or they inflate, which destroys the dollar's purchasing power gradually. Either way, paper assets denominated in dollars are going to suffer. Your 401k is sitting right in the crosshairs of this. Every stock, every bond, every mutual fund in that account is a claim on future dollars. But what if those future dollars are worth significantly less? What if the purchasing power of your retirement account gets cut in half, not from a market crash, but from inflation? This is already happening. Real inflation, the kind you experience at the grocery store, at the gas pump, in your insurance premiums. It's running way higher than the official numbers. The government says inflation is 3%, but your rent didn't go up 3%. Your food costs didn't go up 3%. Your healthcare didn't go up 3%. The real number is probably double or triple that. And here's the thing about inflation. It's a hidden tax. It's a way for the government to reduce the real value of their debt without officially defaulting. But it also reduces the real value of your savings. Your 401k might show the same number, or even a bigger number, but what matters is what that number can actually buy. Now, I want to take a quick moment here because this is important. If you're sitting on $100,000 or more in retirement accounts, there's actually a way to protect yourself that most people don't know about. It's called a gold IRA. Basically, it lets you hold physical precious metals inside your retirement account without triggering taxes or penalties. I put together a free guide that explains exactly how it works. It's in the description below. Worth checking out if you want to understand your options. No pressure, just information. All right, back to what's happening in the markets, because there's another layer to this that's absolutely critical. The commercial banks, the big institutions, they're net short gold futures by a massive amount. They've been suppressing the price for years by selling paper contracts. But here's the problem. They're running out of physical metal to deliver against those contracts. The vaults are draining. The available supply is shrinking. And at some point, this imbalance is going to snap. When it does, we're going to see a price move unlike anything in modern history. Not because gold is going up, but because paper currencies are going down. Gold doesn't change. An ounce of gold is still an ounce of gold. But the number of dollars it takes to buy that ounce, that's what's going to explode. Look at what happened in the 1970s. Gold went from $35 an ounce to $850. That's a 24x increase. But it wasn't really gold going up. It was the dollar collapsing. The purchasing power of the dollar got destroyed, and gold simply maintained its value. People who held gold preserved their wealth. People who held dollars and dollar-denominated assets got crushed. We're setting up for the same thing, except this time the numbers are going to be bigger. The debt is bigger. The money printing is bigger. The imbalances are bigger. Everything is bigger, which means the correction is going to be bigger. And here's what really keeps me up at night. Your 401k isn't just exposed to inflation risk. It's also exposed to counterparty risk. What does that mean? It means your wealth depends on other people and institutions fulfilling their promises. Your mutual fund depends on the fund company staying solvent. Your stocks depend on the companies staying in business. Your bonds depend on the borrowers paying back their debts. Your brokerage account depends on the brokerage not going bankrupt. Every single layer has counterparty risk. Physical gold has no counterparty risk. If you hold it, you own it. It doesn't depend on anyone else's promise. It doesn't depend on a company's balance sheet. It doesn't depend on a government's fiscal responsibility. It just is. And in a world where trust in institutions is eroding, that matters more than ever. Think about the banking crisis we saw recently. Silicon Valley Bank, Signature Bank, First Republic. These weren't small community banks. These were major institutions with billions in deposits, and they failed. Overnight. People woke up one morning and couldn't access their money. Now the FDIC stepped in, and most people got made whole. But what if the crisis had been bigger? What if multiple large banks had failed simultaneously? What if the FDIC itself didn't have enough money to cover all the deposits? These aren't crazy hypothetical scenarios. This is what happens in real financial crises. And the next one is going to be bigger than 2008 because the system is more leveraged, more interconnected, and more fragile than it's ever been. Your 401k sits right in the middle of this fragile system. It's in the banks, it's in the brokerage firms, it's in the mutual fund companies, it's in the stock market. Every single piece of that chain has to hold for your retirement to be secure. And history shows us that in a real crisis, chains break. Now, let me show you something else that's happening. The wealthy, the people who really understand how money works, they're not keeping everything in paper assets. They're diversifying into hard assets, real estate, art, collectibles, and especially precious metals. They understand that when the system gets shaky, you want to own things that exist outside the system. There's a reason why every major family office, every sovereign wealth fund, every serious institutional investor has gold in their portfolio. It's not because they're gold bugs or conspiracy theorists, it's because they understand portfolio theory. They understand that gold is negatively correlated with paper assets. When stocks and bonds go down, gold typically goes up. It's insurance. It's a hedge. It's the asset you hope you never need but are grateful you have when things go wrong. And things are going wrong. The signs are everywhere. The yield curve has been inverted for months. That's historically been the most reliable predictor of recessions. Corporate bankruptcies are rising. Credit card defaults are rising. Commercial real estate is in trouble. Regional banks are still struggling. The economy is being held together by government spending and money printing, and that's not sustainable. When the next crisis hits, and it will hit, your 401k is going to be ground zero. Stock prices will plummet. Bond values will crater as interest rates spike or inflation runs wild. Your account balance will shrink, and there's nothing you can do about it, because you're locked into the system. Unless you take action now. Unless you understand that diversification doesn't just mean owning different stocks. Real diversification means owning different types of assets, paper and physical, financial assets and hard assets, things that exist inside the system and things that exist outside it. The time to prepare for a crisis is before it happens. Once it's underway, it's too late. The banks freeze withdrawals, the markets halt trading, the government imposes capital controls. You become trapped with whatever position you had when the music stopped. I'm not saying you should panic. I'm not saying you should liquidate everything tomorrow. But I am saying you need to seriously evaluate your exposure to paper assets. You need to understand the risks you're taking, and you need to consider whether having 100% of your retirement in the traditional financial system is really the smart play right now. Because here's the bottom line. Your 401k is a bet. It's a bet that the dollar maintains its value. It's a bet that the financial system remains stable. It's a bet that the government can manage its debt. It's a bet that inflation stays under control. It's a bet that the institutions holding your money stay solvent. That's a lot of bets. And if any one of them goes wrong, your retirement is at risk. Gold is the opposite bet. It's a bet that none of those things matter because gold has value independent of any system, any government, any institution. It's been money longer than any currency in existence. It's survived every empire, every war, every financial crisis. And it's going to survive whatever comes next. The question you need to ask yourself is this. Do you want your retirement security to depend on the competence and honesty of politicians, central bankers, and Wall Street executives? Or do you want at least part of it to depend on something that's been trusted for thousands of years? I know which bet I'm making, and I think if you really look at what's happening, if you really understand the risks in the system right now, you'll start to see why so many smart people are moving at least a portion of their wealth out of paper and into physical assets. The 401k full of paper might look safe on your statement, but that's just numbers on a screen. When the crisis comes, and it always comes, you're going to wish you had something real, something you can hold, something that doesn't depend on anyone else's promise. The exit door is still open, but it won't stay open forever. And the longer you wait, the more crowded that exit is going to become. Take a hard look at your retirement strategy. Understand what you really own. And make sure you're not the one left holding nothing but paper when the music stops.